Would like to welcome everyone out to our Savvy Long-Term Care Planning Workshop on this wonderfully cool summer afternoon here in Scottsdale, Arizona. I can think of nothing better than what we can do on this beautiful Wednesday afternoon than be inside in air-conditioned comfort. Before we get started, did want to just run through a couple of housekeeping things. This webinar is being recorded, and as such, we are going to defer all of the questions until the very end. But we do want to answer your questions. And so on your screen, there should be a little button that says Q&A. And if a question pops up that tickles your brain, please click on that Q&A and submit the question. And we'll be sure that we'll get it answered either at the end of the workshop, or we might even have to follow up afterwards. So please do that if you have any questions that pop up. Also, just kind of looking through other things that are coming up, want to make you aware of that. As a firm, one of our missions is to help our clients make better financial decisions. And we know that better financial decisions come from good education and an empowered attitude to be able to know what the moving parts of the decision are. So this year we've had a number of workshops. This one obviously is on long-term care, but we do have another one coming up later in October that we've just added that's going to be about Social Security. And that should be a fun one. We're not only going to be talking about Social Security claiming strategies, but we're also going to be talking about the most recent report from the Social Security Administration that speaks to the solvency of Social Security and what that means for both our retirements as well as the retirements for our children and grandchildren. In addition to getting together to talk about Social Security, we do have a couple of fun events coming up. Our annual Client Appreciation Gala is coming up on Friday, October 23rd. Many of you have said, hey, we want to come earlier and get home earlier. So we're starting a bit earlier at 4. But if you're also a night owl and want to stay up till 8 and party with us, we'd love to have you. And last but certainly not least, we are going to be hosting a wreath-making event for all faiths, and that's going to be on December 4th, and we invite all to come and have a good time with us. So with that said, many times when we talk about long-term care planning, the common attitude that we hear from clients is that they do not want to spend any time at all in a nursing home. Or as we jokingly like to state, long-term care planning can feel like an all-expense prepaid trip to a nursing home. But that's really not what it is. When we're talking about long-term care, we're really talking about how to provide good health care in reasonable environments so that the goals of our clients are met. It's really not about living alone in a nursing home. And in fact, we want to prevent that as much as possible. Typically with long-term care, the care itself is categorized into 2 different categories. The first of which here is skilled care, and that's typically provided by medical professionals such as doctors and nurses, physical therapists, and it's meant to treat either acute conditions or to rehabilitate injuries and accidents. Most long-term care is actually considered more on the secondary side, which is custodial care. This type of care tends not to be provided as much by medical professionals, but rather by family members or by certified nurse practitioners, or not nurse practitioners, but certified nursing assistants and so forth. And we're going to talk about when and where you might receive both of those types of care. With long-term care in particular, it normally surrounds 6 activities of daily living, and those are bathing, dressing, eating, transferring, toileting, and incontinence. And then the secondary part of that is many times as we age, we can be pretty good or pretty solid with a couple of these activities, but just need assistance to be able to accomplish a couple more. And that assistance might be having somebody nearby in the house to be able to assist, or having somebody right there to be able to make sure that it's being taken care of properly. Most of these activities can be provided by aides that are not formally medically trained to the level of a nurse or a doctor. With long-term care, typically the environments that we receive care would be in 2 different types of centers. The first of which is home and community-based care and facility-based care. With home and community-based care, this is exactly as it sounds. Most of our clients, when we talk about long-term care planning, they want to stay home or they want to stay in a home environment, such as living in an in-law suite with children or living in the guest casita in the backyard. They want to be around for the birthday parties and the Sunday football games and those sort of things. So when we talk about home care, the idea is to be in an environment that's safe and provides for healthy living while also providing the necessary assistance to come in to make sure that it's clean, that things are being taken care of, and that conditions are being monitored so that as we age and our need for care increases, that is being monitored and being provided for successfully. Many times, family members are the number one provider of long-term care for us during aging. One of the biggest drawbacks to having family caregivers, though, is that caregiving, it's not it's not a temporary thing. It tends to be permanent and it tends to be 24/7. And so because of that, we do have to rely on community-based care to be able to help with certain activities. One of the most popular services of community-based care is what is known as adult daycare. And it is exactly as it sounds. So imagine this, if you are a caregiver for a family member and for the most part things are going well, but you need to leave on a business trip and you're going to be gone for 5 or 6 days. What do you do with mom or dad to make sure that they're safe, to make sure that they're getting their medications at the right time, that they're getting fed, and so forth? There literally are adult daycare centers. Many times they're attached to a nursing home or an assisted living center where you can drop off and your family member, and you know that they're going to be well cared for and be safe for that period of time. And then at the end of the day, you can go pick them up. Sometimes these can also be overnight stays on a temporary basis, which can provide that necessary respite for home caregiving. There is a cost to these, but the cost tends to be significantly less because they tend to be just day-to-day services or drop-in type services. The other common areas that we see care being provided is in the facility-based care. And this is what many people traditionally think of when they think of long-term care, independent living, assisted living, and nursing home or skilled care. It's also important to note that the largest growing or fastest growing segment of this is what we refer to as CCRCs or continual care retirement communities. And because it's growing so quickly, I want to emphasize and educate on that. So the concept is that nursing homes and assisted living centers have learned that people still want to maintain that home-centered care. And so but most people are reluctant to move out of their home into a facility until the time is too late. And so they tend to overstay the time in their home and get into unhealthy or even unsafe conditions. So with the continual care retirement community, the idea is that you can buy into an apartment into a larger facility. When you buy into that and do what they call a buy-in, the cost can be pretty significant. It can be a couple $100,000 all the way up to, more than $1 million. But when you do that, you buy into an apartment that you never will have to move out of again in the future. They allow you to go in and remodel it and paint the walls and put in the granite that you want. You can decorate it with the furniture that's important to you, and that becomes your new home. Once you move in, you do pay a monthly rent, but in exchange for that rent, you get a number of services such as housekeeping, laundry services. You get some temporary medical care to come in and check on you. And then you also have that assurances that if something happens, if there is a trip or a fall or a stroke or something, that you have immediate access to medical care and people that can check in on you to make sure that you're safe. As your need for care increases over time, you never have to move out of that apartment. Or I should say, in most cases, you don't have to move out of their apartments. There are some extreme times when you might, but you can continue to receive care in that familiar environment. If you are married or have a spouse or a partner, you two can stay in the same room and in the same apartment and continue to live there. And lastly, most of these facilities, when you do the buy-in into the CCRC, if you happen to live longer than your financial resources can pay for care, in most cases, they don't require you to move out. You can continue to live there and receive the care that you need in that great familiar environment, even if you don't have the money to pay for it. So we are seeing a lot of our clients migrating to these types of facilities, knowing that at some point in the future that they're going to need care and they want to be prepared for when that time comes. One of the key questions we want to answer today is how much does care cost? And it really depends on the type of care you're receiving and where you're receiving it at. So these are average rates for both the state of Arizona as well as Maricopa County for the Phoenix metro area. And a home health aide, on average, if you're getting 44 hours a week of care, comes out to be about $7,000 a month, which is about $84,000 a year. Now, keep in mind, for most people, they don't need 44 hours of care a week. Most home health aides will have a minimum visit of 2 hours. And so if you need someone to come out 4 or 5 days a week for 2 to 3 hours, they can take care of most of the tasks that need to be done that day, and not have to use up the full 44 hours. It's probably somewhere between 10 and 15 hours a week. Because of that, home health aides in a home environment tend to be one of the lowest cost solutions to be able to provide high quality care. Next up on the list would be assisted living, and this would be an assisted living center or more of a traditional nursing home environment. Because it's a more formal environment, that assisted living is really providing similar services to what a home health aide would be doing. But being in a formal environment, that cost is actually a little bit less than a full-time home health aide. And then lastly, the average cost for nursing homes with a private room, those are about $8,200 a month. I will tell you that this price can swing widely from facility to facility and the level of care. There is one more enhanced level of care called memory care. And in the memory care facilities, the costs tend to be about 20 to 40% higher than this because there is a lot more responsibility and care being provided. Another common question is, doesn't Medicare or Medicaid cover long-term care expenses? And it's important to note that Medicare is structured to provide medical care that typically happens in a doctor's office or in a hospital. And as such, it does not pay for custodial care. The key word here is that Medicare is for rehabilitation. They want to either treat an acute illness or they want to be able to treat injuries such as breaking a hip. And so any long-term care services that they provide are really meant to be temporary. And I'll give you a common example is that if someone were to fall and break their hip, they go to the hospital, they are operated on, get a replacement hip, and Medicare pays for the majority of those costs. They are then discharged to a rehab hospital, and Medicare will pay that rehab hospital for up to 10 days of service to literally get the patient back on his or her feet. In extenuating circumstances, if additional rehab is necessary, Medicare may decide to add an additional 90 days of rehab in that rehab hospital, but only if they view it as being rehabilitative and not custodial. But in that situation, when somebody falls and breaks their hip, after 10 days of therapy, they're typically not ready to be fully independent and to go home and to manage those activities of daily living, particularly like transferring and bathing and so forth. And so that's when it's really important to have a strategy in place to have that home health aide to be able to come in and spend some time to make sure that care is being provided, that a hygiene is being provided, and things are going in the right direction. A common question is, what about Medicaid or All-Techs? Medicaid is a common word that we use to define welfare, and Medicaid and All-Techs do pay for long-term care services. In the state of Arizona, Medicaid is called All-Techs, which stands for the Arizona Long-Term Care System. In other states, it goes by different names, such as in California, it's called Medi-Cal. Now, Medicaid will pay for long-term care, but it's really intended to be for low income and low asset adults. And there are a lot of surprises that come with Medicaid. So if you ever talk to anybody that's planning on using Medicaid to help pay for these expenses, there are some very strict rules that you have to be aware of. The first of which is that if you're single and you want to qualify for Medicaid, it has an income max, meaning that if your income is even $1 over what the income max is, you won't qualify for Medicaid. In Arizona, that income max is only $2,900 a month, or $2,982. So for example, if your Social Security payment is $3,000 a month and you have no other assets, Medicaid will disqualify you because your income is too high to qualify to be eligible for their plan. They do allow you to have some assets, but only up to $2,000 in assets to qualify for Medicaid. So as you can see, as these levels are very low, the purpose of Medicaid is really to help those that are truly in financial circumstances to require this type of subsidy. The second surprise for Medicaid is that there's a 5-year look back. Sometimes people will have assets and decide that they want to get on Medicaid, and they'll gift the assets away or they'll spend them frivolously. Whenever somebody's applying for Medicaid, the application requires them to submit 5 years of every financial document relating to their financial well-being. And Medicaid does an audit, and they will look and say, okay, where did the money go? And if they feel like money was spent or given improperly, then they will withhold paying any benefits until a certain period of time in future. In essence, they're forcing you to go back and find that money to be able to pay for your care. As a horror story, I did have an acquaintance that her son was her power of attorney, and he thought his mom needed more care. And so he sold her house out from underneath her and then kept the proceeds, and he liquidated her bank accounts to make it so that she was, eligible for Medicaid. When she applied for Medicaid, they went back and did the 5-year look back, and sure enough, they did withhold benefits for almost 4 years, forcing him in essence to spend the money that he was given that he had taken from his mother to be able to pay for that. So because of the low level of limitations on the income and the assets, we typically do not recommend Medicaid as a strategy for most of our clients. And then lastly, the third biggest surprise is that Medicaid might accept you, might be willing to pay, but the facilities may not want to keep you there for longer than 6 months. And so most licensed facilities in the state of Arizona are required by law to have a certain percentage of their beds available for Medicaid patients. But most of these facilities are for profit. And as such, if they have a private paying person in that bed, they could charge $6, $8, $10, $12,000, whatever the going rate is. But the Medicaid patient in that same bed may only be paying a portion of the going rate. So as a result, every 6 months, the facilities can move their Medicaid patients and request that Medicaid move them, which means that then you're in that circumstance of having to find a new facility to live in, maybe as frequently as every 6 months. Next question is, what's the forecasted cost of care? And unfortunately, like any difficult question, it has it depends answer. Depending on your gender, the cost of care and the time of care is what's going to be the biggest determinant. It is forecasted that on average, men over the age of 65 will need care for at least 2.2 years. At the average cost of care, that comes out to about $175,000 for that care. Women, on the other hand, tend to live a little bit longer. And so as such, the forecasted time frame of care is about 3.7 years. And at the average cost of care, that comes to about $295,000. A common question we get is, why does it cost more for women than men? And there really are two reasons for that. The first of which is that statistically speaking, women tend to live longer and have better longevity than men. That's a portion of it. But the other part is that typically men receive care on a free basis from a family member for a period of time before they graduate to paying for care. So what we're seeing statistically speaking is that men actually receive care at timeframes similar to women, but many times they're receiving care from a spouse or a family member free before they hit the statistical surveys and so forth. So the statistics say men only receive care for 2.2 years, but we know in reality they're receiving care for a longer period of time. It's just not being tracked or compensated. So for a husband and wife over the age of 65, the forecasted cost of care in today's dollars combined is about $470,000. If we round up just a little bit, we're looking at about $500,000. And with that comes one of the biggest disconnects that we're seeing. When couples age 65 and older are surveyed, only 8% of them estimate that they are going to need care at some point in their lifetimes. The statistical reality, though, is that more than 70%, or excuse me, nearly 70% of seniors over the age of 65 will need long-term care. And this number is probably going to get even bigger as we see that not only are we living longer lives, but now with some of the miracle drugs, such as GLP-1 and so forth, that people are living healthier lives. And so we're going to be living into our 90s longer and maybe even into our hundreds longer. So here's the problem. As financial advisors, to be able to provide a safe and secure retirement, the cost of long-term care aging really remains the biggest threat to financial independence. And if we look at how we can pay for care, here are the most common buckets of money that we can pull from. As we discussed, Medicare and Medicaid really are not great funding vehicles for most of the population or for most of our clients, which leads us to the most popular funding mechanism, and that is spending our own savings, Social Security, and pension funds. After that, we do look at using home equity, and that can be utilized in a couple different manners. One is selling a house and using the proceeds to be able to pay for care. Number two is to use a home equity line of credit, or even a reverse mortgage can be an effective tool to be able to provide for care. And then lastly on the list, transferring some of the risk or some of that cost of long-term care through the use of long-term care insurance. In a very simplified breakdown, let me show you how some of the math works. Let's say a nursing home or home-based care costs $10,000 a month. Even though you have somebody coming in and providing that care, there are still going to be some personal expenses. Things like, if you want to buy, holiday gifts or birthday gifts for family members, going out to get your hair done, or occasionally going out to eat. So we add in some personal expenses there. If we estimate the total monthly cost, then would be about $12,000. To pay for that, let's presume your Social Security is about $3,000 a month. You're receiving $4,000 a month from savings or an IRA distribution. That brings the total income to about $7,000 a month. If $12,000 is going out in the form of expense and only $7,000 is coming in the form of income, that leaves a deficit of $5,000 that needs to be covered from somewhere. Many times it comes from savings. It can also come from home equity, as we discussed, or the use of long-term care insurance. In looking at long-term care insurance, there are typically two different varieties that we look at for solutions. The first of which is traditional long-term care, which has been around for approximately 40 years. And then more recently, over the last about 10 to 15 years, a new form of long-term care insurance called hybrid insurance is becoming much more popular. Traditional long-term care, typically, I like to refer to this as it feels and looks a lot like how auto insurance works. And the concept is this: with auto insurance, you pay a premium to buy a certain amount of benefits that over that period of time, if you get into a car accident, then the insurance company is going to pay out benefits to repair or replace your vehicle, to repair or replace any property that's damaged, and to pay for some medical expenses. The downside to auto insurance is that many times if you pay that premium for 6 months to a year and you don't get any benefit back from the insurance, it kind of has that feeling like you threw money away, right? Traditional long-term care has that feeling as well, where just by means of example, let's say you were to purchase a policy at the age of 60, the premium was $4,000 a year, and you paid that premium for 25 years until age 85. You would pay into that policy at least $100,000, not counting inflation. And if you passed away without ever getting any long-term care benefits out of the policy, it does have that feeling that that $100,000 was taken away from the estate, and there was no benefit that was to be received. But despite that, traditional long-term care does provide the highest benefit per premium dollar, and it is incredibly flexible. So we do look at it because it does have some great features there, even if it does have that use it or lose it mindset. When looking at long-term care policies, there is a sense of it, jokingly, that we state that it is kind of like looking at an all-expense prepaid trip to a nursing home or home health care. These policies are medically underwritten, so you don't have to be in perfect health, but you do have to be in decent health to qualify. And then we just look at what level of benefits you need to purchase. In the previous example, we were looking that there was forecasted a $5,000 a month deficit. So if we wanted to buy a $5,000 a month policy, then we choose for how many months we want the benefits to be available. And that creates a pool of benefits from which we can draw from to pay for benefits when necessary. These are some factors that can affect the premium. The older we are, the more costly it is. If you want home or home and facility care, that can affect the premium. Inflation riders affect the premium. And then joint or spousal life. Um, Putting two people on a policy increases the premium, but it's not a pure doubling. And the reason is that the long-term care insurance industry does provide a discount for joint applicants. And the reason for that is if you're living with a spouse or living with a sibling or living with another family member, the insurance companies realize that the longer we're living with somebody else, the less likely we are to have a claim because we take care of each other better. And so we do highly recommend that when applying for policies, whenever possible, that you apply jointly. Perhaps, most traditionally that's with a spouse, but it could be with a sibling, or it could even be with another family member to be able to receive those discounts. In comparison, the hybrid type of long-term care insurance is a little bit different, and I'll walk you through that here. On the surface, it looks very, very similar to the traditional long-term care. It's medically underwritten. The benefits are similar. You buy $5,000 a month for a certain number of months and so forth. But here's where it gets different, is that the hybrid type of policies, they avoid that use it or lose it. And I'll show you how that works here. Typically, these policies are based off of a life insurance contract or an annuity contract. And this is the way that we look at it is with traditional long-term care, the probability is that you would pay $100,000 in premium over 25 years. Or with these types of policies, you take that same $100,000 and you set it aside as your budget for long-term care expenses. The insurance companies then they'll take that 100,000, and in this situation, we're going to use life insurance as the base. So your 100,000 goes in as the cash value of the policy, and then the insurance company will add long-term care benefits on that. Typically, and a good estimate would be in the neighborhood of another $200,000 to $300,000 of benefits. So collectively, if you were to die without using any benefits, your family would get $300,000. But if you need care, then the insurance company will pay out for your care the death benefit of $300,000 in monthly installments to be able to pay for your cost of care. So what we love about this is that it does give you that opportunity to be able to set aside some money to pay for your care, but you don't have to fully cover the full estimate of $470,000. It tends to be a much more economical way to be able to get care without having to worry about where that care is going to be coming from, or where the finances for the care are going to be coming from. So, all right. So as we've discussed, the problem with long-term care is that the cost of it can really take away from a secure retirement. And we do view long-term care expenses as being the single and largest threat to financial independence. The solution is really just good planning. And so we do invite everyone to come in and set up a plan that works for you and your family. When we get together, we're going to ask three basic questions. The first of which is who's going to provide the care? Every family is different. Every family has its own moving parts. And many times the family is not the ideal caregiver in that situation. So we have to look and say, okay, what's going to be ideal to provide that care? The second question is, where do you want the care? 99 times out of 100, our clients are telling us that they want to stay at home or in a home-based environment. Perfect. There are a lot of ways to be able to accommodate that. And then lastly, how will you pay for the care? We literally go through that same type of spreadsheet example to say, well, here's the cost of care. What income sources, what saving sources do you have to be able to pay for that care? And is there any deficit that we need to account for? Additional factors to consider when putting a plan together are these. And I don't want to go through all of them, but I will emphasize a couple of them. One is what your current health is, and if there are any chronic conditions that could reduce mortality or extend life but not provide a great quality of life. Military service. Retirees from military service, for the most part, are eligible for VA benefits to pay for long-term care services. However, spouses of military retirees, while they do qualify for TRICARE for health insurance, they typically do not qualify for VA benefits for long-term care. So that provides a different planning paradigm that we need to manage. Family history. This is actually becoming one of the biggest things that we have to manage for because we now have genetic testing that can help us understand better whether we're predisposed for illnesses that can require longer long-term care stays. And I'll give you an example. We do have a couple of clients where both of their parents suffered from dementia and Alzheimer's. Our clients have gone and gotten the DNA testing done and have determined that they have the same DNA makeup that makes them more likely to get Alzheimer's later in life. Unfortunately, Alzheimer's, the average mortality on that is about 6 to 7 years from diagnosis, meaning that instead of planning for 3 to 4 years of care, we need to plan for more like 6 to 8 years of care in those types of situations. But really, the key thing is that when we're doing this plan, we want it to be customized to our clients. And so we do take into account all of these circumstances and conditions to come up with a plan that makes the most sense, both for the near term as well as the long term. In making these plans, everyone's situation is unique. Most people want to receive care at home. And the plan doesn't have to cover all the possible costs. There is some variability in this, and we want to make sure that we account for that as well. So in summary, proper long-term care planning should allow you to maintain control of your life and your assets as you age. Once again, we're not trying to do an all-expense prepaid trip to a nursing home, but rather we want to make sure that financially and physically and health-wise that it's the best solution for you and your family, both for the short term and the long term. And with that, we're going to turn it over for some questions and answers that we'll be doing through the Q&A. And also, I'd like to extend that invitation for everyone on this call to please reach out and let's schedule some time to be able to make sure we understand what your long-term care strategy is, whether that's for you or for family members that you want to make sure are cared for. Just give me a second. I'm pulling up the Q&A here.
Looks like you did such a thorough job that nobody had any questions.
All right, it looks like all the questions have been answered on the Q&A. And so with that, we'll thank everybody for spending some time with us today and let you go enjoy this wonderful summer afternoon in Arizona. Thank you, everybody.